This is Japan Market Brief. Here is your daily update on Japan markets for global investors. Japan's market tone improved on March 17, but the main issue stayed the same: the yen. Stocks rose modestly, yet the bigger question was how close Japan may be to stronger intervention language or action as dollar-yen hovered near 159. 4. The Nikkei 225 gained about 0.34% to around 54,005, while topics rose 1.16%. That was a better session than the near-flat picture seen the day before. Global risk sentiment also helped, with the S&P 500 up around 1%. So at the index level, Japan looked steadier. But that was only part of the story. USD/JPY remained near 159.4, which meant investors were still treating the yen as the main macro variable. This was not a session where the equity rebound fully displaced the FX narrative. That is where the continuity with March 16 becomes important. Yesterday, the market was still balancing Bank of Japan tightening expectations with intervention risk. Today, the focus tilted more clearly toward intervention rhetoric itself. Reports indicated that Japanese officials were ready to take decisive action if moves in the yen became excessive. In practical terms, that keeps the 160 area as a line markets are watching closely. It does not mean intervention is guaranteed, but it does mean traders have to price in policy event risk more seriously. Normally, a weak yen supports exporter sentiment, but once intervention fears start climbing, the same currency move becomes less straightforward. What helps earnings expectations can also make the market more fragile if a sudden policy response becomes more likely. The top stories all pointed in the same direction. One headline emphasized that Japan was ramping up verbal intervention on the yen. Another focused on how close the currency had moved to the 160 warning level. A third highlighted that the market was on guard for action, even if Tokyo may have less room for intervention than it had 2 years ago. What matters is the combined message. Investors were not reacting to one isolated quote. They were reacting to a pattern: repeated warnings, a sensitive currency level, and rising awareness that FX stability has become a policy priority again. That helps explain why the market could look calm on the surface and still feel unsettled underneath. If the yen weakens a bit more, the policy response becomes a larger part of the valuation framework for Japan. One stock to watch today is Nidec. Unlike the broader market story, this one comes with a fresh company-specific update. NHK reported on March 17 that Nidec set up an external expert committee to examine management responsibility. That came after the company disclosed on March 3 that improper accounting had been found at a Chinese subsidiary and that the issue would likely produce roughly a 16 billion yen hit at the net profit level. That gives investors a more concrete single-name risk to monitor. On March 4, Nidec said it expected no direct effect on shareholder returns and laid out a business improvement plan. So the market is now judging whether the company can ring-fence the accounting issue, restore trust, and keep the problem from spilling into the wider investment case. Nidec matters today because it adds a second layer to a market otherwise dominated by the yen. Macro still sets the tone, but stock selection can quickly shift when a large Japanese industrial name faces a governance and disclosure test at the same time. The next step is clear. Watch whether officials escalate rhetoric further, and watch whether dollar-yen pushes even closer to 160. If those two things happen together, intervention risk could move from background concern to a much more active market issue. At the same time, equity investors will want to see whether the broader risk rebound can continue. If global sentiment stays firm, Japan stocks may keep some support. But if FX stress increases, that support may not be enough on its own. That is the latest for Japan markets on March 17.